weeks, we've been featuring a guest covering a topic that is critical to owners of small to mid-sized companies who are navigating their business through these challenging times. Our schedule began with a discussion of government programs and financing. Then we jumped over to operational tactics to survive and thrive. That was last week, both of which can be found on our website at renma.ca. Today we're very excited because we'll be talking M&A, a topic that's near and dear to my heart and Renaissance's bread and butter. We'll be joined by Axel Christiansen to dive into the topic of business transition strategy in a COVID reality. Okay, so before we get going administratively, if you've tuned in before, this will be a repeat, but if you want anonymity through this presentation, please be sure to change your screen name as others within the seminar or webinar will be able to see your name. If you're having any technical difficulties, we've created a ask a question user. So you can send any issues you may have to that user. Also, if you have any questions throughout the presentation that might come up from the topics that we're discussing, please send those questions directly to the ask a question user and we'll try to get to them either throughout the presentation or at the end if we have time. Okay? Great. So to kick things off, and for those who don't know, my name is Kevin Shaw. I'm a Senior Vice President at Renaissance Mergers and Acquisitions. Renaissance M&A is an advisory firm, is a boutique advisory firm with a focus on assisting small to mid-sized entrepreneurial clients for all their M&A and corporate finance needs. Generally, or broadly, this means that we assist companies with between $5 and $100 million in revenue. We definitely have clients on the smaller end of that and even some above 100 million, but generally that's the size of the market that we play within. Our services include helping business owners sell their business. So that would be a full sale or a partial sale to minority shareholders. That could include employees. We also assist buyers through the buying process, which means everything from due diligence, valuation, financial modeling, and of course, in both instances, negotiating on behalf of our client to their benefit, of course. Okay, so I'd like to welcome my colleague and resident realist in the office, Axel Christiansen. Axel has been in the world of corporate finance for some 25 years. Sorry, Ax. He started working at Van City Capital, and then the BDC, and most recently as a Senior Vice President at Renaissance M&A. Axel is a CFA charter holder and has his MBA from UBC. And in his spare time, he reads and then rereads quarterly economic updates from governments around the world to stay sharp. That was a shot. But also,
okay, no, don't believe that last part, please. Way more exciting than that.
Okay, well, welcome, Ax. Nice to see you again.
Kevin, thank you for having me on the show.
Yeah, of course. First things first, I mean, we don't need to go into a background of Renaissance, but maybe you can give the listeners some background on your role at Renaissance as a deal lead and an SVP.
Yeah, so as a deal lead, basically we're helping entrepreneurs through the process of selling the business from start to finish. So that starts with giving them a realistic assessment of what the company is likely to be worth in whatever the market environment is, doing some reverse diligence on their company, giving them some ideas of areas where they might want to look at improving operations or other aspects of the business before going to market. Then putting together a complete marketing document for them, telling the story in a compelling manner that's going to resonate with professional, high-level, either strategic acquirers or private equity firms, and then getting out there, going to market, and building as much competitive tension as we possibly can to achieve the best value and the best terms for our clients when they're looking to exit. And then making sure that all the things that they're promised in terms of compensation are actually achieved after closing.
Mm-hmm. Perfect. Great. So I think that gives a bit of, let's our listeners know at least the perspective that we're coming from when we're talking about this COVID reality that we're in M&A. So just because I've said on other webinars, I'll give a bit of foundation to the times that we're in. And I think you'll echo all of these sentiments, but by many measures, we're in unprecedented times. The economy is headed for a formal recession with real discussion of a prolonged depression. Unemployment is increasing faster than any time on record. The health of the global community is at risk. companies are at risk of failing, and a new normal around us is forming before our eyes. So with that gloomy backdrop, there does seem to be some positivity on the horizon. So I guess my first question, Ax, if we just jump right into it, would be, what is the state of M&A right now? And what was it like at the beginning of the year versus right now? So what was that inflection point like?
Yeah, so let's start with where we're coming from. We're coming from what was strongly a seller's market. So there was lots of capital chasing transactions, lots of buyers out there. Lenders were lending money freely and on very favorable terms, super low interest rates. Private equity groups still have, but had record amounts of dry powder that they were chasing transactions with. Economy was stable, and there were still more buyers than willing sellers because the demographic shift was picking up steam, but still not into the thick of it. And so we're routinely outperforming expectations from the value perspective on engagements. Right now, I mean, that's shifted dramatically in a very short period of time, obviously. M&A is a lot slower than it was just a few weeks ago. Completely to be expected. M&A is a cyclical business, and whenever there's a sort of volatility, you're going to see M&A transaction volumes drop significantly. In the last recession, it dropped off about 50% from peak to trough, and so it wouldn't be unreasonable to expect something like that, or maybe even a little bit further given the current circumstance. There was a survey done of M&A advisors recently, and 80% said they were seeing less deal flow, and 50% of transactions were on hold. So that kind of gives a flavor of how quickly this has kind of hit M&A. But I think the one thing I should emphasize is that doesn't mean that all deals are dead. A number of deals have paused. We have some that are paused for a variety of reasons. Maybe a private equity group that has some buyers in their portfolio, they have to attend to those, and they don't have the bandwidth to be looking at new engagements at this point in time. They might realistically just want to see how the market is developing for the particular company they're looking at. They don't want to be catching a falling knife, so they want to have a little time pass just to get a little more understanding of how this is going to play out. And then there's also good reasons for pausing. Like we're working with a food distribution business, and their volume is double what it normally is, and they're bursting at the seams just trying to keep up with all the unusual volume that's being created by this COVID reality. And so they're in no position to be able to handle the diligence process right now because of that volume. So we've had to pause and just wait for things to settle down a little bit there as well. So there are deals that are still going to go ahead, but these are predominantly going to be defensive businesses that are demonstrating they're able to hold their own, or even better, showing improving results in the current environment.
Right. And so for the people listening, just to be clear, deal volumes falling off, presumably is going to pick back up, but the deals that are getting done right now and in these times of uncertainty would be with businesses that you would say are in a defensive industry or are less encumbered by the economic circumstances that we're in.
Yeah, I'd say the supply and demand situation is still actually favorable for that kind of business, because there's certainly less money chasing transactions right now, but the money that's out there is concentrating on a pretty narrow subset of companies in those defensive industries and those ones that are able to outperform. And so there's still good buyer interest. Like we're in market right now with a defensive company, and we're seeing a very normal buyer appetite, very normal process for that company.
Right. Great. Okay, so transaction volumes fall off. Presumably they're picked back up, but maybe in a slightly different flavor. A question that all the business owners on this webinar right now are probably wondering is they're thinking about valuation. What's this doing to valuation? I mean, You and I, we talk daily about what's happening in the public markets, but what is or what will happen in the near term to valuations for private companies in your view?
Yeah, that's always top of mind with entrepreneurs. I think before getting into that, I think just a couple of takeaways I'm hoping that entrepreneurs get from the current experience. There's a saying in our industry that the market tells you when it's the right time to sell. You don't get to pick when it's time to sell your business. And we've been banging that drum for a few years with all the favorable market conditions. But there's still a lot of entrepreneurs that would want to opt to sell on their own timeline. And then you have something like this come along, and that will set a lot of companies back several years before they're going to be in a reasonable exit window. if they want to maximize their value. So
Mhm.
being mindful that when the market is hot, when the ingredients are right, you should seriously be considering the transaction as opposed to looking at other timing influences that might be specific to you. The other thing is, when you're in a process, get to it. Like, charge due diligence and get that thing closed as quickly as possible, because there are transactions that were going in February that were maybe slower than they should have been, and now they've dragged into this, and that's going to compromise their ability to close. So dedicate the resources to get it done quickly when you're in a process. To answer the valuation question, I think you'd have to be pretty full of yourself to say you have a real clear understanding of what exactly is going to happen. So I don't know, and it depends is my formal answer. And that's pervasive. Like, we were on a call with a bunch of business valuators last week. I was on a call with 10,000 CFAs on a call last week. I was on a call with M&A advisors from around the world yesterday. And everybody is grappling with trying to put some construct around how do you value public companies, private companies, and everything between in this environment. So, I'm a good company saying I don't know for sure. I'd say the educated guess is in the near term, there's going to be downward pressure on valuation. There's going to be an uncertainty discount. The world is definitely a more dangerous place than it was a few weeks ago. So there's going to be a broad discount for that uncertainty. There's certainly going to be less capital flowing. The banks are going to be more conservative over the near term, maybe the medium term. M&A and valuations live and die on capital availability. And so I think the day of the 3 to 4 times EBITDA cash flow loan is gone for the time being. And so that's going to mute valuations. There are definitely some buyers on the sidelines. So less buyers means downward pressure on valuations. And the public company multiples are down as well. And that's the currency that public companies use to buy companies. And so that's going to decrease their valuation appetite as well. So broad-based, there's going to be downward pressure on values. The exception being those defensive or companies that are stable or outperforming. I think they'll still attract some consistency in their valuations. And if you don't see erosion on value, you're probably going to see erosion on terms. So I think you're going to see earnouts coming back. There's just so much more uncertainty around what future cash flows look like that buyers are going to increasingly structure around that to give themselves a little more comfort.
Yeah, and those are all such great points, Axel. I think if you think about those defensive companies, or even just companies with good bones, companies that were run well, you're going to come out of the other side of this with the bottom falling out of the market, and a lot of those companies that maybe weren't so well run succumbing to their inevitability, right? But then the companies that are left, you're talking broadly, but maybe some of those companies have values that are maintained or even increased just because of that supply-demand shift needing to hit equilibrium again. Would you say that, like, you would see that for a good well-run company?
Well, yeah, and now you're talking about kind of medium to longer term, and so what happens with valuation really depends on how this COVID thing plays out. There's a lot of people talking about a V-shaped recovery. If we're all out of our houses in a month or two and largely back at it, hopefully things bounce back. If that actually happens, which I think is just doubtful based on a lot of stuff I'm reading, but if that's the case, then you and I will be able to normalize around this. Okay, this was a very difficult period for a lot of companies, but if they're back performing at their previous level, that is clearly a non-recurring event, and away we go. And I don't think you take a big valuation hit. If we're into an L-shaped recovery and we're grinding it out for a few years, clawing back, then obviously future cash flows are significantly impacted, and you're going to see a negative impact on valuations for most companies. And then there are folks talking about an I-shaped recovery, which is straight down, but I don't want to even talk about that scenario.
Okay, I'll stay away from it then.
Yeah.
We got a good question from the audience. For full value, how long should a company in a non-defensible industry wait? And I think this kind of comes back to your initial point, which is, when market conditions are good, you got to jump on the situation. And time and time again, you and I have heard, hey, why don't I just run this company for another year and then sell? And the answer is always absolutely, you can do that, earn another year of wages and do that, but you never know, right? And so if you think about those people now, not in a defensible industry, how long, the question, I guess, how long should a company in a non-defensible industry wait, or should they wait at all?
Yeah, so again, that really depends on what the recovery looks like. So if we're in a slow grind, you're going to be at it for a while. Generally, you want to be able to show 2 solid years that are going to support whatever value you're expecting to get for the business. So I'd say you're going to have to build the business back up, and then you're going to have a couple of years operating at that level of EBITDA performance to be of interest to a purchaser and to get the value that you need. So does that mean we're bouncing back in a year and then you got 2 years to do that? Or, well, if we bounce back in a year, I think you can normalize around it. You can probably be selling in pretty short order. If it's a longer grind, you're going to have to get yourself back to where you used to be and show a couple of years thereafter. So we're probably looking 3-4 years, which was kind of typical after the last recession. It was 3 or 4 years before companies were in a position where they were saleable for something close to the value that they would have received prior to the recession. But again, that all kind of depends on how this recovery looks, because it could be very different. And it also depends on expectations. We are increasingly being approached by folks that went through the last recession. And the baby boomers, they're 60-something at the time of the last recession, rolled up their sleeves, built the business back up. Now they're 70 plus and they've been hit again. And some of them are saying, I'm not up for this. I lack the desire, the energy to go through this again. And I want to sell, and value is not my top consideration. So if your metrics change, then the timing to your exit will change as well, because you may be able to sell a little sooner, but you're going to have to recognize that you're going to leave some value on the table.
Yeah, no, it's a great point. And I think one thing I caution, we've had a few of these webinars and obviously talking amongst the community, people want to know when we're going to be back. And to that last question, when we're going to receive full value. And I think the fundamental way that we're valuing businesses going forward is going to change, because there's more market risk. I don't think that many people were probably factoring in a pandemic into valuations beforehand. So if you take the company A that's doing X today and that same company doing X tomorrow, I mean, there's just more systematic risk within the system. And so maybe the bounce back or the new normal is actually at a bit of a muted level, assuming they're not benefiting from this pandemic.
Yeah, it'll be interesting to see how that plays out, because there is certainly an elevated appreciation of the risk that wasn't on the radar before. There's also boatloads of stimulus and really low interest rates, which might offset some of that. So.
Yeah. Okay. So painting a rosy picture here, Ax. If we shift gears just slightly, could I ask broadly, what are you hearing from sellers out there? What are you hearing from potential business owners that are looking to sell or are in the process of selling?
Yeah, I'd say they fall into 3 buckets. So the ones that were thinking about selling, and they are absolutely not thinking about selling right now. They're putting out fires in their business. They clearly recognize their value is down and potentially well down, or the business might not be saleable in its current state. So they have no illusions of selling the business right now. They're going to have to work to build it back up, or just preserve the business. There are others that are maybe stable or doing okay or taking a hit, but they're not at risk of going out of business. And their mindset is more, darn, I've missed the window. I'm going to have to grind through another 3, 4, 5 years to get to the point where I want to be with this business before I transition. And then there are the ones that I just touched on, the ones that have been through the last recession, don't want to go through this one. And their metric is get me out quickly. I'm not expecting top value. I recognize that, but I want to sell to a good purchaser that's going to look after my staff and is going to be able to continue the company that I've founded or been running for 20 plus years. So those seem to be, and then of course there's the minority that are counter-cyclical, that are, run off their feet and might be thinking about selling, but they don't have the capacity to do it because they're so busy right now.
Right. Yeah, a really wide range, I guess you could say, in terms of what we're hearing from sellers. But I think it's important to maybe know what bucket you fall in if you are a seller on this webinar, so that you can appropriately address your needs going forward. Okay, so then the flip side would be, what are we hearing from buyers?
From buyers, I'd say we've heard from more buyers in the last 2 or 3 weeks than we did in the previous two years. There clearly are a number of buyers that are on the sidelines, but there are also a different segment of buyers, or buyers that have been out there and been frustrated in the previous market, unable to buy something because it was such a seller's market. And so they were frustrated by the amount of capital chasing deals and high multiples and all that. And I think they now see a market opportunity for them to get in and actually win a transaction because there's potentially less competition on those deals. So either just winning a transaction will be a victory for a lot of those folks, or even seeing a lower valuation that would be attractive to them as well. So that's not a bad strategy. Like, studies have shown that acquisitions that are done immediately after a market drop like we've seen tend to be the ones that generate the highest rate of return, because presumably you're buying at a bottom, the market's only improving during your ownership period. Ideally, you're buying at a reasonable valuation. So
Right.
yeah, so I think there's a lot of people that identify that and are out there reaching out to folks like us saying, is there anything that we can look at?
Right. And so I guess the broadly, if you have the means to buy right now, means being the capacity, the ability, and the cash, it would be a good time to make that assessment, or even to just jump feet first.
Yeah, and I think the only caveat there is, as a buyer, put myself in the buyer's shoe, I don't want to be someone that's going to be catching the falling knife. And there are going to be some falling knives out there. Like, there are a number of businesses that are not going to survive this. And so you want to make sure that you're not putting your money into one of those. So a couple of things: diligence has to be really thorough. There are certain things that you could, to some extent, assume in diligence previously that you cannot assume in this environment. Like, you have to look at a vast majority of whoever you're looking at buying's clients and really understand, how sound are they? Are they going to be around? And what sort of revenue erosion are you going to experience if some of these clients go under in this environment? Same thing with the supply chain. You just can't take for granted that their supply chain is going to continue to operate the way it did for the previous 10, 15 years in this environment. So there's more diligence required. And then I think you need to structure around some of the risks as well that we touched on. So driving on valuation for starters, and then structuring more back-end consideration that's driven by future performance. So earn out or something along those lines, so that you're mitigating your performance risk.
Right. And so that maybe that bleeds into kind of the follow-on question that I have, which is like, what is a buyer's strategy in this COVID world? And maybe that means, structuring around some of the risks, so long as they believe in the core competency of the business.
Mm-hmm. Yeah, and I think a lot of the buyers we're talking to now that are aggressively out there are ones that have a longer term view. So they recognize they're going to buy something that's maybe going to be choppy. They want to make sure it's a business that's going to get through this, but they're looking at the value of this business 4 or 5 years down the road. And so there are a number of people that are reaching out that are looking to get in on broken deals. So, some of the deals that we're working on that the buyer has stepped to the side, there are a number of buyers now coming up and saying, well, do you have any transactions like that? We would love to get in on that transaction, because they've got a different perspective. Oftentimes these guys might be in a new fund, so they don't have the legacy investments that they have to look after. So that's one of the reasons that we're seeing some new buyers out there in the universe.
Yeah, I know I've been in touch with buyers that are specifically looking for, what you would call a distressed asset as well, right? And those buyers, I think, can be viewed in quite a negative light from a public perception perspective. But in a lot of ways, you've mentioned the bucket of sellers who are just not prepared to go through another downturn, reinvent themselves, and come out the other side. And so there are buyers for those companies as well. Unfortunately or fortunately, I guess, depends on your perspective, right?
Yeah.
Okay, so I had an interesting discussion today, actually, Ax, with one of our colleagues, Ali, and he mentioned that there's this, with public markets being a bit of a yo-yo right now, and particularly at this very moment, be on a high, whereas on the private side, company valuations are likely going to be muted at this very moment or depressed slightly. That delta between the public company return and the private company return might be growing. And so do you think it would be fair to say that, like, more capital is entering the private equity equation, in which case there might actually be this small or large influx of cash kind of chasing good deals?
Because the public multiples are higher and the spread is bigger? I haven't seen it, but I mean, theoretically, that may be the case. I think there will be a concentration towards larger buyers, strategic private equity or otherwise, partially driven by the reduction in credit availability. right? If I'm a small family office or an individual looking to buy a company and I was contemplating using a fair bit of leverage, I don't know that that's going to be available to those players. Or if I'm a small company, I might not have the credit facilities available to me that a very large multinational is still going to have available to them. So I think there'll be concentration to that kind of buyer for that reason. And the publics, if their multiple valuations hold up, which is hard for me to understand why we're at where we are in the public market right now. But if that continues to be the case, then I think they will increasingly see private companies as a very accretive means to growing their business. Because in this environment, it'd probably be more difficult to grow organically. And so they will likely need to look at acquisitions to keep growing.
Right. Well, that's great. So I have another question. So there are likely some people on this call are definitely within the broader sellers universe that their businesses are facing a reality that maybe their business life as an entrepreneur, or at least within the industry that they're in, is facing a limited future, or maybe they just simply want out of their business. And so because we're in these temperate times, what are their options? What are their tangible options right now as sellers? If they're on a downturn, can their business be sold? And then what if they need to move quickly? So kind of a 3-part question there for you.
Yeah. Vast majority of businesses don't sell. So there is only a relatively small subset that are saleable, but an assumption that you're saleable within that category, everything's saleable at a certain price. So it really comes down to value expectation, I think, for those folks that are in a more challenging economic environment and might have declining results. And so our answer to that is we've been developing a fast track methodology to get to market. Usually where valuation maximization is the objective, then running a full-blown process that usually takes 6 to 9 months. And you do a lot of research on 75 to 100 potential purchasers, and you're grinding through dealing with all those potential purchasers and getting them to compete against each other. That's how you maximize value. If the metrics have changed and it's more around timing of getting out and making sure it's in the hands of a capable buyer, then what we've been talking about is slimming down that process dramatically, where you can get it done in 3, maybe 4 months. You put together less of a package, you go out to a smaller, more tailored boutique group of potential buyers. You make it very clear to the buyers that we're looking for an accelerated process. And in exchange, you've got a seller that is understanding that they're probably going to sell for a lower value. So that we think there's an audience for that right now, just given what we're hearing from entrepreneurs. And that would be sort of an answer to folks that just don't want to fight it out for another 4 or 5 years and are really uncertain of what's coming down the pipe.
Yeah, that's a great answer. Thanks, Ax. And so we have a question from the audience actually as well that actually ties in nicely to the idea of selling more quickly. And so the question is site visits. They're difficult in this market. And so how do buyers and sellers address this issue just generally from a comfort perspective or from a risk perspective?
Yeah, so as I say, a normal process is 6 to 9 months, and ordinarily once you're at LOI stage or letter of intent stage, or even sometimes even before that, if it's a really high potential buyer, we'll allow for a site visit. But usually that's reserved for after letter of intent for confidentiality reasons. Because of this current environment, we'd be pushing that back as far as possible. So the way we've been explaining it to potential purchasers right now is we're going to go through process, we'll get to LOI, we'll get into diligence, but the site visit portion is going to have to be later once things are a little more certain and travel is a little more permitted. So we're just pushing it to the back end of what is a longer process. And in reality, there's a lot of companies that site visit doesn't add a lot. So if it's a very specific type of manufacturing business, then yes, you're going to want to see the plant, you want to see what the equipment looks like and see how they do things for sure. If it's a tech company, 90% of tech companies look the same. There's a bunch of kiosks and maybe some exposed wood on the walls and a bunch of desks and a bunch of big monitors. So you're going to get a lot less out of a site visit for that type of business. And so it's not as critical for some companies as it might be for others. But so right now we're pushing the back of the lengthy process. You know, if you're going to do a real accelerated process before COVID is gone, we haven't crossed that bridge yet. I mean, you can try and do it virtually, but that's not a situation we've had to handle as of yet.
Yeah, and hopefully you're right. Hopefully it changes before at least we have to encounter it. But I am sure that there are going to be some instances where, you know, buyers are going to have to accept some of that risk, or get more familiar with at least the person behind the business virtually prior to closing the deal.
Yeah.
So a question from the audience, which I think speaks to the buyers that are on the webinar. So, I mean, I've heard you say hundreds of times, M&A lives and dies on debt availability. And so what does the state of financing from the big six banks for M&A deals is the question, knowing that interest rates are low, but availability is maybe touch and go?
So I definitely feel M&A lives and dies on capital availability. And so I've been reaching out to the banks. I can't speak for all of them, but I've certainly spoke to several of them. And I'd say the consensus is they're going to be supportive of existing clients to a degree. They're certainly going to be fully supportive of any government programs where the risk is not on their balance sheet. But at the end of the day, these are companies that are in business to generate a profit and to generate profitability for their shareholders, right? And so they're going to be looking at what is a very risky economic environment, and they're going to be behaving accordingly. So I think if you were looking to switch banks, that's going to be extraordinarily difficult. If you're looking for an aggressive financing package for any purpose, that's going to be very, very difficult. So I think there's going to be a significant reduction in capital availability over the next 3 to 6 months, just until there's a clearer view of how this is all settling out. They are all ramping up their special loans groups significantly in anticipation of what's to come. And so that's just not an environment that's generally conducive for bankers being wildly enthusiastic about handing out new money.
Right. I have another question I'm reading here. So do you expect
I should just say on that, back to that point, if you are looking at acquiring a business, because of that potential risk, you should be talking to your banker very early in the process. You know, as soon as you're got a glimmer in the eye that you might be a successful party, you've collected some information on a company you're looking at, run it by your banker to get a sense of feasibility of financing, because there's no point in going too far down the road if ultimately you're not going to get the capital you need.
Yeah, no, that's a great point. We have a deal right now where that's very applicable. Luckily, the financing was approved prior to COVID, but I know that the buyer is very much on top of maintaining that accessibility to the debt through COVID and making sure they have updated forecasts and updated numbers. So in a way, there's more power given to the banks, but I think it's all in the name of getting the deal done.
Yeah.
Do you expect many companies to sell for asset value with no goodwill? How can we verify the quality of the assets?
That is a good question. So valuation theory is that the company is going to sell either for asset value or a multiple of the cash flow that the company is generating, whichever is higher. And so if there is limited or no cash flow or not enough cash flow to validate a value that's higher than asset value, then it will sell for asset value. And so the way you would normally validate asset value is you'd have an appraiser go out and do an appraisal on the equipment based on what similar equipment would sell in the marketplace. The challenge that you're going to have in this environment is that if you're in a really declining economic environment, asset value can be very fluid. And there may be, like if you're selling restaurant equipment in the next few months, I think what restaurant equipment was worth 6 months ago to what it's going to be worth 6 months from now is going to be a very different thing. And so just as it's going to be challenging to figure out what EBITDA-based valuations of companies are going forward, it's going to be difficult to figure out what appropriate value for specific assets are.
Yeah, good answer. And so I guess when you're talking about the two valuation approaches generally, earnings-based and asset-based, that leads to another question that a user has sent me. The second bite strategy. So the idea that a seller would retain some of their business through an acquisition has typically, at least in the past, been viewed as a risk mitigation for buyers. so that they get to have somebody that knows the business, transitions the business, and has some skin in the game. Do you
Mhm.
think that the second bite strategy will be more used more now? And if so, maybe for different reasons?
I think we can see more of that because the dynamic is shifting in buyers' favor. So generally, the sellers would like to have all cash closed, done, be done with it. Most of the times, they don't want to have a significant stake in the business. There are some that do, but a lot of times that's not the case. The buyers will probably have the negotiating power to call for that more often. And then from a seller's perspective, if I feel that my value is down and I'm selling for
Hmm.
suboptimal value, I might now want to be a little bit more on board for that sort of approach, because now I'm selling less at what I consider to be a low value. And if I'm partnering with a significant partner, large private equity firm or a significant strategic or something like that, then I can have some confidence the business is going to be around longer term, and they're more than likely going to be able to grow that value. So my second bite is going to be less unpalatable than the current bite that I'm taking. So
Right.
I think for those reasons, you'll probably see more of that kind of structure.
Yeah, and it might even be in some instances a good option for sellers where they're, think of it maybe even as like an equity financing type of scenario where you take some chips
Mhm.
off the table, bring in a partner,
Yeah,
and you might get diluted via an injection of cash that kind of
yeah,
helps your company either maintain its operations, or, as many people have probably heard, in these downtimes, it's kind of companies are primed to double down on their BD and marketing efforts, and so you might need that strategic partner or that equity injection to do so.
yeah, indeed.
Yeah. So we have another question in terms of red flags for you. Okay. So um, we do internal due diligence as kind of one of our first steps in the process.
Mhm.
So in the current environment, what operational red flags would you look out for, which could lower the value even further, which perhaps did not exist a month ago? Are there any operational red flags that jump up?
Red flags. Well, I don't know if you call them red flags. Some of these things are just so glaring. So if they're not operating, that's a red flag, right? So if they've got COVID issues that have shut them down, that's a problem. Then otherwise, I repeat a couple of things I touched on earlier, just drilling into their customer base. What is the strength of those, especially their key customers? And that might be difficult to get. Like how are you going to get detailed information on the health of other customers of the business? So you might have to make just some inferences based on whatever industry those clients are in. The supply chain might be a little easier to confirm, but you want to know that that supply chain is still sound. What would other red flags be in this environment? Capital availability. So I think you're going to want to speak to the lenders to get a sense of what that relationship is like, because
Mhm.
that will give you a hint as to how likely they're to be supportive of this business should you, fall into more challenges going forward after you've acquired the business.
Mhm.
Yeah,
Yeah,
those would be some of the red flags.
I might even say, if you're thinking about going through an acquisition, or you yourself are a seller, um, I think your general attitude through economic hardship is really important, right? Do you have the energy, or does your business have the management team with the strategy to push through and come out stronger? Is there a pivot that might be in your future? I think a buyer would love to, I would love to hear that, right, as a buyer,
Mhm. Yeah,
versus the opposite, which would be a seller that's really down and out about their business. I think that's going to be a harder story for a buyer to accept, and frankly for you to live with at the end of the day. So a flag in terms of making your company more sellable or retaining some of that value would be to really put your nose to the grindstone and see how your company within your industry can come out stronger through COVID.
indeed.
Yeah. Um, a pretty direct question we have here. What industry is ripe for acquisition in this environment? So maybe, Axel, maybe if you have some defensive industries that you're thinking about that are solid industries for a buyer to maybe look at, maybe the value's dropped, maybe the value hasn't dropped, but it's somewhere
Yeah.
to put your capital right now.
Yeah, so ones that we've seen directly that are doing well, packaging industry, there's a lot more going through grocery channels. So if there's packaging through that channel, that's a positive. There's a lot more going through the Amazons of the world. So folks that are selling corrugated boxes and that sort of packaging are doing very well. So that's sort of counter-cyclical. A lot of things in healthcare are counter-cyclical. Anything to do with food. I touched on a food distribution company that we're working with. if they're in the right segment. There are winners and losers in all of these subsegments, but if you're in the right segment, you're probably seeing significant volume growth. So it might be a situation where you've got historically healthy company and now a company in a worst case scenario that's doing even better and will likely revert to being just a healthy company again down the road at some point. But who knows, there might be a long-term macro shift in the kind of way we do things that would benefit these companies for more than just a COVID blip. Infrastructure is historically counter-cyclical, right? When we're down and out, the governments start to spend money on infrastructure spending. So anybody that's in those segments is likely to see some good results over the near term. Those would be some of the kind of conventional ones. Technology companies with recurring revenues, where you can see through the client base is still healthy, right? Your clients aren't imminently going under. I think that's a good place to be, and you're seeing capital flowing into that. I mean, just look at Shopify; it was crazy multiple prior to all of this, and it's just becoming more valuable, and that's a function of the value that they're providing and the expectation that people are going to be setting up more online stores with all the unemployment that's happening.
Right. Fantastic. Before my parting words, do you have any words of wisdom for would-be buyers or sellers that are listening in today? Maybe words of caution or the alternative?
For sellers, I'd say the message is that there's still transactions happening. Understand where you kind of fit in the broader spectrum of deals. Are you defensive or are you not defensive? Because that will determine your saleability in the current environment. Understand what you're looking for in your transaction. Is valuation still your top metric? In which case, that's probably going to impact your decision around when you go to market. And if not, then maybe something more imminent is possible. For buyers, I think it's likely to be an improving dynamic for the vast majority of companies out there. The counter-cyclicals and the ones that are still strong, I think those are still going to command strong valuation metrics. But there's probably opportunity for you out there, but do your homework, do your diligence, don't catch the falling knife.
Fantastic. Well, insightful as always. I hope everyone listening today got to take something away from this session. It brings to an end our 3-part series. If there are any topics that you'd like to see discussed, we will likely be jumping into another 3-part series in the future. So if you have any topics you'd like to see discussed, or if you simply have any questions for Renaissance, please don't hesitate to reach out. And on that note, thank you and stay safe. Thanks, Axel.
All right, thanks.